This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So we're now going to go through, having looked at your performance, we're going to look now at your position. So switching our focus from profit or loss and moving it over to position. Okay. So when we go through and look at your position, essentially we're looking at liquidity and your working capital ratios, which, if memory serves me right, you've seen all of them before. So it shouldn't be too difficult a session, really. It should be some good stuff to get yourself stuck into within the real exam. So if we look at liquidity, I think we know what liquidity is. What's liquidity all about, ladies and gents? Yeah, the ability to pay your debt off, isn't it? So here, liquidity allows your users to see if a business can pay its debts as they fall due. But don't just stick thinking about the ratios. The key thing about liquidity is what balance within your financial statements, what shows liquidity. We are liquid if we have lots of excellent cash. Okay, so always think about your cash movement first in any analysis before then supporting it with a ratio. You see so many people, particularly in the case study, really go to town about these ratios and talking about current ratios and quick ratios without mentioning cash. And sometimes the situation is that we had cash last year, we've got no cash this year, and we're overdrawn. We're not very liquid, but people start saying, oh, there's a reduction in the liquidity as shown by the current ratio and the quick ratio. There's not much change either, so we don't need to worry about it. Yes, we do. If we had cash and we don't have cash, you need to be worried about it. Okay, so let that serve as a warning. Rant over. What you've got there is your current ratio, dead simple. Current assets divided by current liabilities. Remember, it's a figure quoted to 1, isn't it? X to 1. Current assets, dare I say it, I will. Inventory, receivables, cash. Okay. Current liabilities, anything that's in current liabilities, really. You tend to see trade payables, tax payables, and maybe an overdraft. Okay, combine those together, fit for your current liabilities. Quick ratio, yes, like Chris, get on with it. I know what the quick ratio is all about. Remember, it's also referred to as the acid test. It gives you a better indicator, if you like, of liquidity, doesn't it? Because we remove the least liquid asset, which is inventory, isn't it? Okay, so just be aware there. The current assets on the top are only likely to be receivables and cash. Okay. So let's go through and look at working capital. I'm not too worried about calculating the working capital cycle. You can think about that if you like at the end. We're just going to go through and look at inventory days, receivable days, and payable days. Okay. Remember how to calculate it. You take a statement of financial position figure, divided by profit or loss, and multiply by 365 days if the figures that you are given for your profit or loss are for 12 months. Okay. Be on the lookout. If things are 6 monthly comparisons, then you need to not multiply by 365. You need to multiply by half of 365, isn't it? So is that 182.5 days? Okay, so the key is looking at the profit or loss figure. Is that annual? Is it biannual? Is it quarterly? Is it monthly? You need to adjust the number of days accordingly. Okay, we'll see that in an example later, whereby in the old syllabus it caught out a lot of people. Hopefully none of my students were caught out by it. There you go. There's the formula for inventory. Inventory divided by cost of sales multiplied by 365. Nice and simple. What we need to go through and think about is why those inventory days could go up and why they could go down. Okay, so increase in days, decrease in days. Do you want to think about it? If you do, pause the video. If not, let's carry on. So if you've got an increase in days, not too good, is it really? Means you've got lots of older inventory, particularly if you're in the fashion or the technology industry. That's a big risk, isn't it? Yeah, because what's fashionable this year may not be fashionable next year, and therefore there's a big risk of obsolescence, isn't it? Of generating too much older inventory that you then can't sell. If you do sell it, you sell it at a reduction in price, and therefore there's going to be a bigger, if you like, hit on your margins and reduction in profitability in future years. More inventory, more stock. Okay, so therefore there's going to be more holding costs. Maybe you need a a bigger warehouse, so you've had to buy an extra warehouse or rent an extra warehouse, which again increases your costs and reduces your profits and potentially your margins. Again, think about holding costs with valuable goods. Think about them with perishable goods as well. If they are refrigerated goods, then again, there's going to be extra costs of keeping those goods refrigerated. Just little things like that that may help you think around a potential situation in an exam question. I don't know. Okay. Bulk purchases. Maybe you've taken advantage of a bulk purchase to get things cheaper with a quantity discount, but the only issue that you have there is an increase in your inventory days, isn't it? As you have more inventory at the end of the year potentially, and that could go through there. Give you issues if you don't sell it, but hopefully you'll be able to sell it next year and therefore take the advantages of the cheaper costs and increase margins. Could be the change in inventory profile. Depends where you live in the world, but if you think about supermarkets, I know we've spoken about supermarkets previously, but that all the supermarkets used to sell was food. Okay, they used to sell perishable goods, didn't they? Okay, so their inventory days were pretty short, weren't they? Because you don't want a long inventory holding period for perishable goods, do we? Okay, you're not going to buy some milk that's 10 or 15 days old or any cheese, are you? No, I don't think so. So what's going to happen there is supermarkets have changed, haven't they? They tend to sell everything. Okay, they sell CDs, DVDs for as long as they carry on being sold. They sell clothing, don't they? They sell homeware. They sell garden furniture, and they have a much longer shelf life, don't they? So as these supermarkets have changed their business, then the inventory profile has changed and the inventory days has increased. Okay, so it's just something to be aware of. It could be that you've bought lots and lots of goods for this new product, and all of a sudden it wasn't as popular as what you thought. Okay, again, that gives you a risk, doesn't it, of increased costs, as you then can't sell the goods for the price that you were expecting to sell them for in the future. Okay, so any of those could give you an increase in the number of days. Reduction in number of days is good, isn't it? I suppose because you're selling the goods quicker. Do just be aware if there's a spike in demand, you have a big risk of stock out, don't you? I.e., run out of goods, and if you can't meet your customers' demand, they will go elsewhere. And with the days or the current days of social media, it's bound to reflect badly upon you, isn't it? Okay, so do just be careful there. It could be that there's been inefficiencies in production, so therefore you have not produced as many goods as what you would have expected by the end of the year, which reduces your inventory days. And there you have it. Not a lot to it. Receivable days, again, your receivable collection period is your receivables divided by your credit sales. So technically it should be credit sales, where financial accountants in this exam, I know you're training to be a management accountant, but in this exam, apart from that first 15% of the syllabus, you are a financial accountant with your financial accountant's hat on. So we just divide by total sales. Okay, technically it's by credit sales, but really it should be total sales. Again, we're going to look at the increases and the decreases in the days. Again, a lot of this will be familiar to you. If your days have gone up, get a new credit controller in. There must be inefficiencies in collection. You need maybe somebody else to come in and try and sort the department out to try and help with that increase in the sales. So particularly when you launch a new product, that there could be an increase in days, mainly because of just the pure volume of sales that have occurred, and maybe your credit control department isn't able to cope with that. Okay, and that's led to inefficiencies in collection. It could be that you've decided to sell overseas, so that's not a bad thing, is it? But if you sell overseas, you grant the customer a bit longer in terms of payment period, don't we, to pay you, because the invoice has further to travel, I suppose, in the post. But these days everything's done electronically, but we still give overseas customers longer to pay, don't we? But if there's been an increase in receivable days, you've got a risk of irrecoverable debts, haven't we? If your customers aren't paying you, and that risk could give you a risk, if you like, of future expenses and write-offs in future years, which can therefore reduce your profits and reduce your future margins. If we look at a reduction in the number of days, it's likely that you've improved your credit control. If you've improved credit control, maybe you've brought some new staff in. and they've implemented new procedures. If you've brought new staff in, are they on a bonus scheme or a reward scheme? If so, maybe the reduction in receivable days could have a negative impact on profitability. Only minor, but it may reduce your profit ever so slightly with your new members of staff and the incentive schemes that maybe we've offered them. Other one could be that you've changed your customer terms. Maybe you've offered prompt payment discounts, and therefore the customers have decided to pay quicker. And if they pay quicker, it reduces receivable days. But don't forget there, your discounts allowed will go up, which increases expenses and reduces profitability. Okay, there we go. Payable days, what have we got there? Again, to work out the ratio, you take your payables, technically divided by your credit purchases. Apologies for the spelling mistake there, but there we go. Technically, it's divided by your credit purchases. Forget that. The only figure that you get within your exam is cost of sales. So payables divided by cost of sales multiplied by 365 days. Okay. Again, increase in days, decrease in days. If there's an increase in days, it's because you're in trouble. Okay, you have cash flow or liquidity issues. Yeah, you're using the terms offered by the supplier to generate you cash, if you like, a short-term form of finance. Remember, it was mentioned, wasn't it, within F1 as your short-term financing methods, using the payable terms to help you with your working capital cycle. It's a very risky strategy, isn't it? But it normally indicates you have cash flow issues. It could be maybe you've negotiated better terms. Is that likely? Maybe you force better terms. We mentioned the supermarkets earlier on and how much power they have over the farmers, the smaller suppliers. So maybe they've just decided to delay the payments to their suppliers. Again, you can question the ethical issues within there. Okay, so be on the lookout for that. And again, the risk that you have is that if you have the cash flow issues, you extend your terms, there's a big risk, isn't there, of losing your supplier goodwill. And if you lose your supplier goodwill, maybe the supplier will no longer supply you. And if you don't have the goods that are being supplied, you then cannot sell them on, can you? So there is therefore that risk that your business starts to go into a rapid decline, isn't it? Okay. Other one, I suppose, maybe not because of cash flow issues. Maybe you were just offered 30-day terms. For whatever reason, you've been paying in 20 days. Haven't done anything wrong, have we? So let's just say, well, why should I pay in 20 when I've got 30 days credit terms? What I'll do is I'll begin to pay my supplier in 30 days. It's not because I've got cash flow issues. It's actually helping me use the credit that's offered to me by my supplier and extending it from 20 up to 30 days. Okay, so it's not always a bad thing. 99% of the times in exams and questions, it is, but there are other areas to consider as well. A reduction in days could be that you put in a new automated payment system that on a monthly basis goes through all the supplier invoices and decides which ones to go through and pay based upon how outstanding they are and who that supplier is. Okay, therefore, that improves the efficiency of the payment and makes sure that things are paid on time and therefore there are no delays in payment. Okay, and the other one that I'd throw in there is maybe you've started to take advantage of prompt payment discounts, which is great, isn't it? You pay your supplier quicker, which reduces your payable period, and then at the same time you get a bit of increased profitability, don't we? Because you've got your discounts received. Discounts received are a credit balance, and credits are good, aren't they, within profit or loss? Okay, there you have it. So that's your inventory, receivable, and payable days. Also looked at liquidity. I think now it's probably the right time, isn't it, to go through there and have a look at a question. Okay, so next video goes through and starts to look at a question. I think it brings in gross margins, brings in liquidity, brings in your working capital ratios. So it brings in a bit of calculation, but at the same time, it also gets us to think about why those ratios have moved. Other than that, see you in the next session.